Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Amgen Inc. Annual Report. Amgen Inc. offers a diverse range of businesses and services that cater to the healthcare industry worldwide. The company's primary focus lies in discovering, developing, manufacturing, and delivering human therapeutics. The list of products provided by Amgen includes Enbrel for rheumatoid arthritis treatment, Oatsla for psoriasis and oral ulcers, Prolia for osteoporosis, XGEVA for skeletal-related events prevention, Repatha for heart disease risk reduction, Nplate for immune thrombocytopenia, KYPROLIS for multiple myeloma, Aranesp for anemia treatment, EVENITY for osteoporosis in postmenopausal individuals, Vectibix for colorectal cancer, BLINCYTO for acute lymphoblastic leukemia, TEPZZA for thyroid eye disease, and KRYSTXXA for chronic refractory gout. In addition to these products, Amgen also markets other medications such as Neulasta, MVASI, AMGVITA/AMGVITA, TZSPIRE, Parsabiv, Aimovig, Elumakaras/Elumakaras, EPOGN, KNJNTI, TAVNOS, RAVICTI, UPLIZNA, and PROSUSBI. The company serves various healthcare providers including physicians, clinics, dialysis centers, hospitals, and pharmacies. Amgen distributes its products through pharmaceutical wholesale distributors as well as direct-to-consumer channels. Furthermore, the company has established collaboration agreements with several prominent companies such as AstraZeneca plc, Novartis Pharma AG, UCB, Kyowa Kirin Co., Ltd., and BeiGene Ltd. For product development and commercialization. The recent surge in Amgen Inc. stock price can be attributed to several key news events and developments over the past year. One of the primary catalysts was the company's strong financial results for the fourth quarter of 2025, which exceeded analyst expectations. This included revenue reaching $9.87 billion and earnings per share of $5.29, surpassing consensus estimates. The positive guidance provided by Amgen for fiscal year 2026 also contributed to the stock's rise. Several financial firms raised their price targets for Amgen following the strong earnings report, signaling increased confidence in the company's future performance. Additionally, regulatory approvals for Uplizna, a key product, were received from the European Commission, offering new treatment options and potential long-term disease control. Amgen also demonstrated its commitment to shareholder value by increasing its quarterly dividend from $2.38 to $2.52. The company's robust sales of key products, such as Prolia and Repatha, continued to drive investor confidence. Furthermore, Amgen's underappreciated pipeline is seen as a driver for durable earnings per share through 2033. The acquisition of Dark Blue Therapeutics in January 2026 was another strategic move that could enhance Amgen's therapeutic portfolio. Overall, these developments have contributed to the significant increase in Amgen Inc. stock price over the past year, with a notable 6-month surge contributing to its strong performance. Amgen Inc. maintains a market capitalization of $199 billion, broadly in line with the industry peer group. Amgen Inc. trades at a higher price-to-earnings ratio of 26 times and a higher price-to-book ratio of 22.98 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 94% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 2.62%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Net income experienced significant fluctuations between 2023 and 2025. Initially, it increased by $6,717 million from zero in 2023 to a substantial amount in the same year. However, this growth was followed by a decrease of approximately $5.1 billion due to potential additional tax liabilities in 2024. Nevertheless, net income rebounded strongly in 2025, increasing by 89% from $4,090 million in 2024 to $7,711 million. Profit margins also underwent changes during this period. In 2023, the operating income as a percentage of total revenues was not explicitly stated, but it increased to 21.6% in 2024 and further rose to 24.7% in 2025. The reasons behind these fluctuations are multifaceted. Net income was affected by various factors, including mandatory price setting for certain drugs under Medicare, lower prices set by CMS for specific medications, increased cost-sharing obligations, and rebate obligations on Medicare Part D and B. Profit margins were influenced by pricing and reimbursement pressures from government and commercial payers. Additionally, potential policies covering importation of drugs, transparency in drug pricing, and changes to government rebate programs also impacted profit margins. These factors collectively contributed to the changes observed in net income and profit margins between 2023 and 2025. The company's financial performance in 2025 was marked by a strong showing of positive operating cash flow. According to the extracted summaries, the company generated $6 billion in positive operating cash flow from debt repayments and repurchases. This indicates that the company is successfully managing its finances and generating sufficient funds to meet its obligations. Furthermore, the company's operating income reached $9,080 million in 2025, while net income stood at $7,711 million. These figures demonstrate a strong financial performance, suggesting that the company is profitable and capable of generating significant revenue. Additionally, the net cash provided by operating activities for both 2024 and 2025 was substantial, with $11,490 million in 2024 and $9,958 million in 2025. Overall, these indicators suggest that the company is indeed generating positive operating cash flow, which is a crucial aspect of its financial health. The company's debt level and interest expenses have undergone significant changes over the past 2 years. Initially, there was an increase in debt level from $2.147 billion in 2023 to $3.6 billion in 2024, resulting in a rise of approximately $1.453 billion. However, this trend reversed in 2025, with a decrease in debt level from $56.549 billion in 2024 to $50.005 billion in 2025. In terms of interest expenses, there was an increase in 2024 compared to 2023 due to higher average debt outstanding and interest rates. However, this trend also reversed in 2025, with a decrease in interest expenses compared to 2024, primarily due to lower average debt outstanding. Overall, the company's debt level has decreased significantly from 2023 to 2025, while its interest expenses have fluctuated over the same period. The financial performance of the company's segments and regions varied significantly in the recent period. In terms of segments that performed well, Repatha, EVNITY, BLINCYTO, TEZSPIRE, UPLIZNA, TAVNOS, and LUMAKRAS showed impressive growth in both US and ROW sales. These products experienced increases ranging from 13% to 95%. On the other hand, segments that performed poorly include Prolia, ENBREL, XGVA, TEPZZA, Nplate, KYPROLIS, Aranesp, AMJVITA, Parsabiv, and Neulasta. These products experienced decreases in U.S. sales, with some experiencing significant drops such as ENBREL's 33% decrease. In terms of regional performance, the U.S. market performed well for several segments, including Repatha, EVNITY, BLINCYTO, TEZSPIRE, MVSI, UPLIZNA, TAVNOS, Neulasta, LUMAKRAS, RAVICTI, and Aimovig. However, some products such as Prolia, ENBREL, XGVA, TEPZZA, Nplate, KYPROLIS, and Aranesp struggled in the U.S. market. The ROW region also had its share of successes, with UPLIZNA, LUMAKRAS, RAVICTI, Parsabiv, and Aimovig performing well. However, some products such as MVASI and Neulasta underperformed in the ROW region. Overall, the company's financial performance was mixed across segments and regions. While some products showed significant growth, others struggled to maintain sales levels. The company will need to address these challenges and identify opportunities for improvement to drive future growth. The company has made several strategic acquisitions to expand its portfolio of products and services. Notably, the acquisition of Horizon Therapeutics plc in October 2023 brought in TEPZZA, a monoclonal antibody treatment for thyroid eye disease. Additionally, the company acquired Oatsla from Bristol Myers Squibb Company in November 2019 as part of the Celgene Corporation acquisition. The company has also made acquisitions of other companies, including Kyowa Kirin Co., Limited, and Numora Therapeutics, Inc. Furthermore, Horizon's inventory was acquired by the company. These acquisitions demonstrate the company's commitment to growth through strategic partnerships and investments. On the other hand, the company has also engaged in divestitures, which involve selling off certain assets or businesses. One notable example is the sale of Oatsla, resulting in intangible asset impairment charges. This move suggests that the company is streamlining its operations and focusing on core areas of business. The company's financial history reveals a consistent pattern of shareholder returns. One notable aspect is the payment of dividends to its investors. As per the extracted summaries, there are multiple instances where dividend payments were made, page 45, page 65, page 78, and page 79. This indicates that the company has prioritized rewarding its shareholders through regular dividend distributions. In addition to dividend payments, the company has also engaged in share buybacks. The extracted summaries confirm that shares have been repurchased on multiple occasions, page 45, page 65, page 67, page 78, and page 79. This strategy allows the company to reduce its outstanding share count, potentially boosting earnings per share and increasing shareholder value. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. The company relies heavily on third-party suppliers for raw materials, medical devices, and components, which poses a risk of manufacturing difficulties, disruptions, or delays that could limit supply of products and impact sales. Supply chain disruptions can arise from various sources, including ransomware attacks, security breaches, tariffs, regional economic activity, natural disasters, public health emergencies, labor disputes, and cyber attacks. The company's reliance on single-source suppliers for certain proprietary products also increases the risk of inventory buildup due to manufacturing difficulties or disruptions. In addition, recent increases in tariffs imposed on certain goods imported into the United States have raised production costs, and potential future tariffs could further increase production costs and disrupt the operation of the supply chain. The company's global supply of products is dependent on uninterrupted operation of manufacturing facilities, which can be impacted by regional economic activity, natural disasters, public health emergencies, labor disputes, and economic challenges. The inventory levels have remained relatively stable between 2024 and 2025, with $6.225 billion in 2025 and $6.998 billion in 2024. However, the company's reliance on third-party suppliers and single-source suppliers for certain proprietary products increases the risk of inventory buildup due to manufacturing difficulties or disruptions. Overall, while there are some pages that mention no concerns about inventory buildup or supply chain disruption, the majority of the extracted summaries highlight potential risks and challenges in these areas. That concludes the financial summary for Amgen Inc. Feel free to comment below, and I will be happy to answer them when possible.